The term market bias or market sentiment defines who is in control of this market. The market is based on the factor of buying and selling, where loss of buying power means the market is bullish, therefore the market will more likely go up, and vice versa, where loss of selling power means the market is bearish, meaning the market is more likely to go down. Without these two concepts, the stock market would not have existed. Therefore, in the trading community, we often refer to if the market is currently either bullish or bearish as market bias or market sentiment. Now, what is market bias? Market bias refers to the general market emotion and the candlestick analysis of each candle anatomy and the general market structure of the current market. And there are also fair value gaps, order blocks, and unfilled liquidity we want to talk about when we talk about market bias. Another way to determine that is to look at the previous day's close or the previous day's percentage change. If the previous day was bullish, well, we can see that there is going to be set liquidities and ranges from the previous day. And then there's also premium versus discount, which is it a good time to sell or buy depending on where the price is. And this is where most institutions use the price premium versus discount to see if it's a fair price to pay or we're overpriced at the moment. Now, how should you incorporate market bias into your day? Now, I usually use market bias to determine what trades I would be taking today, whether it's bullish or bearish. That would be coming from my market bias. And the market bias helps us to determine what high time frame POIs we should be looking out for and possible retracements we would be expecting that aren't signs of reversals, which basically means that sometimes there are liquidity runs and liquidities reversals, which we want to look out for depending on our market bias. Now, if the market is bearish, we would expect a pullback. If we were at a premium price, we're dropping down, and then it reverses. We would not count that as a reverse. We would count that as a pullback to go even down. Now, so I would incorporate this into my day by the start of the day. We would enter our news and corporate prices, checking if we're trading on news day and how should we adapt to the trading of the news day and how should we change our plans. And from there, I'll adjust to my market bias, looking at the general market, looking at the previous days, and looking at how the market is for the past week or so. And then I'll look at my market structure, and then that's where I find my high time frame POIs and what I should be looking out for. And then I would use my LTF confirmation that I talked about in my LTF confirmation entry video, in another video that I posted a couple of days ago. And here's my technical analysis process for this. So I go from market bias all the way to high time frame analysis and then all the way down to low time frame confirmation. Now here, if you can see that we obviously have this is on the daily time frame, the 4-hour time frame. We have a lot of breakup structure. We have upward momentum, but then we tapped into this liquidity, and we can see there's a 3-wick swing right here, which tells me that this is more likely of a reversal. And what we get is we have a market reversal right here, a market structural shift. Now I wouldn't confirm this is a market structural shift because first of all, we've tapped into a fair value gap and we have not tapped into this order block. But what gives me the confirmation that this is going to either be a reversal or an enter is because of this swing right here. Now we created a swing high, and this shows me that there's an amount of liquidity here that has been taken due to the factor that we all only wicked here. Now, if you take a look at a regular breakup structure, that we can see there's inconsistent wicks, but this shows me that buying attempted to enter this price and try to close, but sellers regained control and pushed it down. And once again, this candle anatomy, we also had another buy process come up, and then we pushed it down again by the selling power. So it tells me that there's strong buying power kicking back in, and this is how I determine my market bias for the day. Now that means I would be more likely to be more volatile to either reversals at this point or a continuation to push down into this order block and even more of a liquidity run, which means that my day is more bearish. And so on the high time frame analysis, which is a 4-hour analysis, the 4-hour analysis, this is a daily, and we're now on the 4 hours, we'll be taking a look at what I mean. So basically we have a breakup structure here, which is basically this. I would not count this as breakup structure. I'll count this more of a market structural shift, is because we continued up here and we did retest at this fair value gap, but we ran through on the second attempt. So therefore, and we have another quick liquidity grab here that we can see over here, which is again liquidity reaching into this order block right here, I would assume. And so I would be really cautious when I take this order. And once we broke through of the structure, we had seen that it tested this order block that is a high time frame order block, and we've tested this once. So I'm assuming that we would be running through this liquidity line and going through. So what I would be looking for more is more of a bearish trade or a bearish setup, or where I would go short because of what the market sentiment currently is. Now my low time frame confirmation, I can see that we have a big fair value gap right here that has been filled once, but we cannot simply rely on this one fair value gap. We can also assume that there's also resting liquidity above here. And since there's a lot of wicks on this day, and since that we already broken this line, we've closed beneath it, and then buying power has attempted to pull back, but we did not go anywhere. We only stopped at this minor order block here that is, I would assume, inducement, but since this order block causes to break structure right here, I assume that this is a valuable zone that people started to short from. And since we closed back down and we wicked underneath this candle, I'll wait for an optimal setup, most likely at this either fair value gap or this order block to take my trade to the short. Now, besides market bias being really important, there's also flaws. Now, although market bias is made from ICD concept, it generally can vary from time frame to time frame. Now, what I mean by this is that I tried market bias for myself and it works reasonably well, but it needs to be paired with a lot of other stuff. You can't just trade market bias on its own because there's always going to be pullbacks, retracements, and also liquidity runs and sweeps. Now, what I mean, I'll show you right here. So this is a versatile, I'm sorry if I spelled that wrong, and there's volatile markets, and there's uncorrelated, and there's correlated markets. Now, the market bias will give you the most versatile method of trading, but it's uncorrelated. What I mean by this is that since this is a more textbook setup for this technical analysis, if there's an untextbook analysis where it's, let's say, a news day messed up the market, we would more likely not trade on that day because the market is very volatile. And when under a volatile market, the market bias doesn't really work because it ranges from time frame. We're not sure if this is going to be pulling back. Now, if we're on the low time frame confirmation, this might be a pullback to all the way to this fair value gap. In that case, we will be taking bullish trades, and then we'll be shorting here. But on the daily time frame, it looks bearish, and so there's uncoordinated ideas of the market bias. But what I try to do is I try to disconnect my emotions from low time frame to market bias and just assume that the market bias is bearish, and I'll only take bearish trades from this setup. Now, on the other side of the page, there would always be high time frame and low time frame analysis. And what I mean by analysis is that what we talked about in the other video, where we go from top-down analysis, where we go from 4 hours all the way to 1 hour and then to 15 minutes for our entry, is very versatile and it's very correlated. We're looking for the same type of trends all the way from the high time frame to the low time frame confirmation, which is very correlated and very versatile when you want to trade in ranging markets or any market in general. And then there's also internal, intraday time frame structure and confirmation, which is more volatile, but it's still correlated because we're erasing high time frame analysis from this picture and only using ITF and LTF confirmation. And the worst of all is uncorrelated and volatile. It's just probably indicators. Like, if you're trading indicators, I get it that indicators are good when you understand the basics of trading. But if you're a new beginner getting into trading and you're using indicators, I suggest you stop now and watch my other video because I deeply explain what my setup is and how it works well for any beginner actually. And it's really profitable, I would say, but indicators isn't really the strategy because it's more relied on there's more lag to it. Now, what I mean by lag is that indicators oftentimes cannot react to real-time data and they will always have a lag behind it, which is why I strongly suggest we do not use indicators. Or you can use indicators that are more SMA, like moving averages and stuff. That would sure help you a lot, but there's still a couple flaws that outweighs the positivity of those indicators. Now, my principles for market bias is that we have to understand that the market is driven by greed and emotions. What I mean by this is the market is always driven by people that are looking to long, and at that point, if they long in a liquidity zone, we would expect a liquidity run, that point to you might look like a breakout, but it more sometimes can be a fake out. Like in this case, we assume that the day is bearish, so we wouldn't try to think that this is going to be a reversal. Although many people might start buying at this point, we wouldn't because we expected a breakthrough of this due to our retest here, and that this has already been retested. This zone has already been retested, that we would break through here again since we have 2 touches. The third touch might be a strong downtrend, and our market bias is showing bearish signals. So we have to put aside everything about what the market is and look at it directly on the charts and the news, basically. Another principle is putting aside self-emotion and focusing on taking the right positions following the bias. So even though this might look like a good long setup, you have to put aside your other emotions and understand that this market might not be a great market to take a bullish trade right now because of the probabilities and what's outlying factors inside this market. So say that if I was a beginner trader, I would look at the setup and think, all right, liquidity zone, we would expect a reversal and we would trade on a bullish time frame. No, we have to dig down to our low time frame confirmation and see that we've closed beneath this liquidity sweep and we have not seen a strong pullback. Therefore, this might not be a reversal that we looked for. And so we have to put aside self-emotions and understand the market from each time frame. Now, another principle is aim to set reasonable goals for the day without compromising your own mental state. So what I mean by this is stop setting 1 to 10 risk to reward ratios. This will kill your mental mood, and you would always look for any trades possible to take to reach that 1 to 10 risk to reward. And you would seriously kill your own trading profitability and your mental state. And trading is all about clarity and staying calm. And if you take trades that sometimes isn't a good A+ setup, you're more prone to lose money than you are to profit. Now, what I mean by this is if you take a trader A that takes 10 trades a day and he takes, let's say, he takes every single trade possible, he's more prone to lose money because of the outlying factors that every single setup is an A+ setup. Whereas we have trader B, he takes 1 trade a day and he only trades A+ setups, which is almost a guaranteed win, for him at least, with his strategy. And he wins that at like a $200 profit, which is a 1 to 2 risk to reward, locking his profits for the 1 to 2 ratio, which is really small, really reachable. Whereas for trader A, if he sets his risk to reward to 1 to 10 for every trade, it is more likely for him to hit a reversal before he hits that 1 to 10 risk to reward. Now, for my trading results, I got 63% just trading based off of market bias. And then there's also a 78% for combining market bias with ICT and SMC concepts, which is really good. Don't be fooled by these numbers. Although these numbers are low, there's no way anyone will get a 100% win rate in the game of trading. That is absolutely not possible. Unless you're a big institution or you're a market mover, it is really unlikely for you to make a 100% win rate in the game of trading. And trust me, 78 is more than enough for you to become profitable. And I use only 56% for using ICT and SMC's concepts alone without correlation between bias and top-down analysis. What I mean by this is I'm going on to the 5-minute time frame and doing whatever I can just to scalp for a trade. And this is not really profitable because each trade is really risky. There's no background information, there's no confluences, and there's no data backing up why I'm going to take this trade. There's no top-down analysis, then there's no information from other time frames. Hence why I say 78% for combining market bias with ICT and SMC concepts. And the only reason I lost these trades was because either my stop loss was too short or I was trading on a news day. Now, what the lesson is that market bias, like any other concepts from trading, will not work if you do not understand basic fundamental analysis and concepts of the market. And market bias only works when you combine both another scale like SMC with market bias or ICT with market bias. And how to incorporate market bias is I'll probably go into market bias should be the first thing you determine on your trading day. This will set the tone for what trades and position you will take for that day. And then I'll go to my top-down analysis, which is keep everything simple, work from your high time frame to in medium time frame, then to low time frame. Make sure you go over each time frame you use and understand structure and possible inducements and pullbacks. And then you want to locate the middle time frame point of interest. These point of interest must align with your market bias, and these structures will help you set up a possible position. Now, I can explain this in detail by showing you what I mean. Now, here I can see that I labeled a point of interest as order blocking the medium time frame, and there's a liquidity sweep right here that I'm looking to break through, and then I labeled this area so when I go into low time frame analysis, I can understand that what I'm looking for. I'm looking for if we possibly broke through and we're looking to continuation down to the seller side. And so after that, I would be looking at my low time frame confirmation. When price comes to your medium time frame POI, wait for 2 candles to wick and show signs of reversals confirming your entry. Now, since we're dealing with a run and not a reversal, it will be the opposite. We're looking for candles to close beneath the liquidity sweep and proceed down with strong momentum and little pullbacks like this one. So if I were to take this trade, I'll probably take it right here and aim for it to go down. And so therefore, that's about it for this video. And apart from that, we have another topic is that realistic goals. You cannot enter a position without expecting a 1 to 10 risk to reward profit. This is a common practice that is a faulty and costly error many beginner traders make. To avoid this, I would always target the nearest liquidity zone as my TP1 and then following to the next liquidity zone as my TP2, making sure even I will maximize my profit chances. So even if I were to take out, I would take out TP1 before I take out TP2. because if I take out TP1 and it shows signs of reversals, sure, I can close my trade with the profits of what I took at TP1. And so that's about it for my video. Thanks for watching. Please like and subscribe for more high quality trading content.